Hello, and welcome to Overlap 101, a series of primers on topics well known but less understood across the tech and finance landscape. I'm Justin Stevens, founder and CEO of Overlap Holdings, and I'm joined by my colleagues today who will introduce themselves if and when they have questions. Today's topic, debt. Debt is a topic that a lot of people are familiar with, usually in a negative way through their personal lives, whether it be student debt or credit card debt. It's something they don't like to think about, and we understand that. But today, we're going to be talking about debt in the corporate sense, so I ask people to leave some of those personal thoughts behind as we have this discussion. We're still going to use some examples from personal life to help people understand the technical mechanics behind how corporate debt works. But for today, the discussion is all about how companies use debt to fund their operations. And that's the key part, using debt to fund a company's operations. The big thing that you're going to learn from today is that debt is actually a very effective means for a company to fund its operations, as long as it has the means to pay that debt back. So, starting from the top, debt is one of three ways that a company can use to fund its operations. Way number one is to sell goods and services, right? Operating a business. That is essentially the reason that a company exists, is to sell you things. Once they have that revenue in hand, a company uses that to pay its employees, pay its expenses, do R&D, and then if there's any money left over, use it to grow the business and so on and so forth. So that's way number one. Way number two is to raise equity, which is a fancy way of saying the owners put money into the company, or new owners come in and put money into the company in exchange for shares or ownership of that company. The third way for a company to raise money, as we discussed, is to borrow it, i.e. utilize debt in order to fund a company's growth and operations. Debt is exactly that. It's borrowing money from an organization or a person, typically a bank, so that a company has money to do what it needs to do to operate and grow. As I mentioned, debt is a contractual obligation that a company enters into with a lender, which basically says, we are going to get money from you today, and down the road, we will pay that money back. And so that is the way that debt works. If we go to the next page, we can look at an example that people understand from their everyday lives, which is owning a home. So this example shows this happy clip art family in front of their new home that they just purchased for, let's just say, $100,000. It's in a neighborhood they really like. They're very happy with it. A lot of people, when you think about a home, think of it as a place to live, but a house is also obviously an investment. You are purchasing a house by buying it, and eventually you will sell that house and either incur a loss or a gain in doing so. For the purposes of this discussion, we're going to look at debt as a function or a tool in terms of determining how much you're going to make or lose through that sale. So in this example, as we discussed, this clip art family buys this house for $100,000. But they don't just pull cash, $100,000 out of their bank account to buy it. They do what most people do when they buy a house, is they get a mortgage. What is a mortgage? It's a loan that you get from a bank. More specifically, it's a contract that you sign with the bank, which says that they will give you money in exchange for you paying it back plus interest across a prescribed period of time. In this example, the family uses 70% of the proceeds of the money required to buy this house in the form of a mortgage. And 30% or $30,000 is money that they contribute from their bank account in the form of equity. Typically, when you buy a house, this is the type of structure that is utilized. The bank will put up 70% of the purchase price, or 60 or 50, or sometimes a little higher, and you're expected to pony up the rest. It illustrates that you have skin in the game and that you care and will take good care of the house because you have an investment in it as well. And as we'll discuss later, the bank wants to know that if the house dips in value, you're going to be covering the brunt of that through your equity as opposed to them. So this is the typical debt to equity split, or the capitalization that, if you will, that people enter into when they purchase a home. We're going to go to the next page and understand the economics that a homeowner faces versus the bank if there is a sale. So on this second slide, you can see scenario one talks about what happens if you're able to sell your house for a gain. As we mentioned, in year zero, clip art family buys their house for $100,000. And a year later, they're able to sell it at a pretty nice gain, right? They sell it for $150,000. Let's say a celebrity moved in down the street and now everybody wants to live in that neighborhood. And so they're able to get all the houses go up in value and they say, we're going to take advantage of that. We don't even like that celebrity that much. We'll sell this house and we'll move somewhere else. So the family sells the house for $150,000, which is great. So one would say, not knowing much about how leverage or capitalization works, oh, wow, the family bought the house for $100,000, sold it for $150,000. They probably made 1.5 times their money. The answer for the family is actually a lot better than that. The home was purchased for $100,000 and sold for $150,000. Let's look at the economics on the left side for the family. As you can see, they sold their equity at the sale price was $80,000, which you can tell from the bar chart over here is $150,000 minus the mortgage gets you $80,000. They purchased the house using $30,000 of equity. And so they wound up with a gain of $50,000 over what they originally, on their original equity. Minus the 1 year of interest payments they needed to make to the bank for the mortgage. And that gets them a total profit of $46,500. So they put in $30,000. They profited $46,000. They more than doubled their money as a result of this trade. That is a great investment for a family to do something like that, or a company, as we'll get to later. And it's all because of leverage, which allowed them to take all of the windfall profits that came from the sale. On the other hand, you have the bank's economics from this deal, right? They get the $70,000 repayment from the family at the end of year one. That covers the original funding they did of 70. So they don't make any money on the sale. The only money that the bank makes on the sale is the $3,500 of interest that they receive from the interest payments over the course of the year. So the bank only makes $3,500 of profit. So a lot of you are saying, well, why does the bank want to do this? The family is getting a much better deal than them. Like, why do banks exist if they're just making so little money? Scenario 2 is really what gives you the answer for that question. As you can see in this case, same story where the family buys the house for $100,000 in the beginning, but a year later, they're only able to sell it for $80,000. So what happened here? Let's say a casino is getting opened down the street and there's going to be a lot of traffic and noise. And the family says, oh, we don't want to live near this. It's going to be a mess. We have, 2 young children. Let's move somewhere else. And so they sell the house, but because other people don't want to live there either, they only get $80,000 for the house. So as with the first example, the mortgage has to get paid back. So the bank gets their $70,000 and their $3,500 of interest, leaving the bank with the same $3,500 profit they had in the first circumstance, whereas the homeowner is actually losing money. They're losing $20,000 on the sale, plus they have to make the $3,500 interest payment, meaning a loss of $23,500, which is obviously not a great thing. So as you can see, the way that bank debt works, or a mortgage works in this case, is it's less reward in the circumstances where there's a gain, but in the circumstances where the asset loses money, there's greater risk. On the other hand, the way that the bank debt works is that there's less return on an upside, but also lower risk if the price of the asset goes down. This is the essential concept and relationship between debt and equity. It's one of risk and return. Debt does not get to share in the upside of a sale or an increase in value of a company or an asset, but it does get they are the first people who get paid to the extent things go bad. And that is essentially what the contract or loan agreement between an equity holder and a debt holder says. And so that is the core component and understanding of the difference between debt and equity, is the ability to get paid first versus the foregoing of upside if good things happen. We're now going to take that exact same example and we're going to look at it through a corporate lens. So here we have examples 2 and 3. Over on the left is a simple example of a company. This is a company there. Let's say 2 people get together and they buy a factory. It's a really small factory. As you can see, they can only fit 3 bicycles up front. But it's their factory and they love it. And they're manufacturing widgets, boxes and boxes and pallets of them, and they're very excited about it. In order to buy this factory, and let's use the same, total round numbers as last time, they spent $100,000. And in order to do that, the partners of the business got together $500,000 of their own dollars in the form of equity. And then they entered into a contract with a bank for a loan for the other 50%, the other $50,000. And they're paying up 5 to 7% interest rate annually. once again, the bank will get paid first before the equity gets to take dividends, or if there's a sale, if they get their money, the bank debt, similar to the mortgage, gets paid off first. However, if the value of the factory increases significantly, the debt does not participate in that gain. They are just getting their $50,000 plus interest pretty much no matter what happens. We then go over to the right side of the page, which takes a look at a more sophisticated company example. So let's say the widget company on the left, mom and pop widget company, expands and grows, and now it's an international widget concern with factories and facilities all across the world. As you can see from the complicated, impressive refinery stack here, there's a lot going on. As this company builds and grows, they will tend to add on additional debt. They're buying a new piece of real estate that they want to build a factory. They're going to want to get a loan to do that. They're going to want to buy a new piece of equipment for their new factories. They're going to want to get debt for that. And so they're constantly and often reaching out and trying to get more debt to pay for the growth of this business. As long as the earnings of the business is growing in line with the debt that they're taking, which usually happens if you're buying additional assets and capital that allow you to do more and grow your operations, then that works. The only issue is that you have to sort out and negotiate, and the lenders need to negotiate with themselves of who gets paid in what order and who gets first priority if things go bad, because much like the second situation with the family, everybody wants to make sure that they're getting paid for the right risk if things go south within a company. And so what you see here is this company on the right has what we call a more complicated capital structure. In other words, there's not just one piece of debt like a mortgage and equity, but there's a bunch of different ones. There's a bank debt, which is a loan from a bank, which is the senior most. The bank debt in this type of capital structure is on the top of this little table, meaning that it's senior to the others, i.e., if things go bad, it's the first one to get paid back. Once again, that probably means that it has a lower interest rate than the other ones because less risk means less return. But the banks have decided that that is the piece of debt that they want. As this company gets bigger and the capital structure gets more complicated, as we mentioned, other people might come in and say, you know what, the bank debt only covers 30% of the capitalization of this company. We're willing to lend the company more money. We'll come in and contractually agree that we'll be below the bank debt if anything bad happens. And in exchange, we'll get a higher interest rate. That type of lender is called a second lien lender, meaning they're coming in behind the bank and they understand that, but they're getting paid more to do so. They still have a borrower relationship where they're just capped out on the interest that they received, but they're willing to do that. And in this circumstance, the company has gotten so big and the capitalization has gotten so complex that there's even a group that comes in below them, which is what's called subordinated debt, which says that, we understand that we're coming behind the bank in the second lien debt. There might not even be specific assets that we can necessarily attach ourselves to, but this is a big company and it's growing well and they got a good chance of paying us back. So we're willing to kind of be junior to these other people. And, we'll take a higher interest rate for doing so because we're confident that they'll be able to pay us back. Some subordinated debt is referred to debenture debt, which means that it's just based on the good faith of the company. It's not specifically tied to any assets at all. As you can imagine, debenture debt gets a higher interest rate than things tied to assets such as mortgages. So that is the example of a complex capital structure. Believe me when I tell you, it gets a lot more complex than this in the real world. There's a whole world and universe of people who negotiate, underwrite, create, and structure these types of facilities. It's a very common activity within Wall Street amongst investment bankers, commercial bankers, restructuring experts, and otherwise. And there's a whole field of study really about financial structuring, financial engineering, about doing this right and optimizing a capital structure, which can sometimes make a difference between a company thriving and succeeding or going bankrupt. Now we're going to go to our next page and discuss some of the different types of corporate debt out there. Obviously, on the previous page, we talked about bank loans, which people remember. We also talked a little bit about debentures, which is what bonds are. A bond is a publicly traded piece of debt, which essentially, is a company's obligations and then gets, instead of going to one bank or several banks, there is a contract that is publicly provided and the bonds are issued either over the counter or on an exchange, and people are freely allowed to buy and sell them. You or I or anybody with a brokerage account can go out and buy bonds in companies like Apple and Coca-Cola and otherwise. and freely trade those bonds and be in that position of the person lending money to those organizations. People have also heard of revolving lines of credit. That is a situation where a company has a amount of money they can borrow from a company, and they can borrow it when they need it and then pay it back to them, when they have the ability to repay. Kind of think of it like a company's credit card, but at a much larger scale, if you will. Revolving lines of credit are very helpful for companies that have intra-month capital needs. Think about making payroll, right? You need a big outlay of cash every 2 weeks or once a month. Using a revolving line of credit allows you to borrow money for the bank, make those salary payments, and then repay it over the next 2 weeks or month as you get revenue in from your customers. Next, we're going to talk, then there's asset-backed loans, which is a form of bank loan often, which is a loan specifically tied to one asset, whether it be an equipment lease or a piece of real estate or otherwise. Probably a good chance right now to hand it over to my colleague, Rob Morelli, to explain what asset-backed securitization is, which sounds similar, but is actually different. Rob?
Hey, thanks, Justin. Rob Morelli here. I'm Director of Operations at Overlap. I spent a decade or so at UBS, where I ran the structured products business for mortgage and asset-backed securities. Asset-backed securitization is exactly what the name implies. It's the process of creating new securities that are collateralized, that are backed by pools of different types of assets. Any cash flowing asset can theoretically be securitized, right? Auto loans, credit card receivables, commercial mortgages. The most popular, of course, being mortgages backed by residential homes, right? In a mortgage-backed securities deal, principal and interest are collected monthly, and they're redistributed to the security holders based on the rules of securitization. You create different rules for the different securities based on different risk-return profiles, which is one of the appealing things about a securitization. And just like in the corporate capital structure that Justin just went through earlier, in a securitization, there's also always an equity class that tends to be the riskiest piece, that takes the first loss, but that also has the most upside.
Thanks a lot, Rob. Appreciate that. So a few other forms of debt just to round it out. Trade finance, people may be familiar with, is the financing of a company's receivables or inventory, a way to manage working capital so that if a company has a bunch of sales, they have that money instead of waiting for customers to pay 30, 60, 90 days for that revenue to materialize. Project finance is also a commonly heard form of debt. This is when a company is doing some new project. Imagine you're a hotel company that owns, 50 hotels nationwide, and you want to build a new one. Sometimes when you build a new hotel, you run into overruns on the construction costs. Sometimes these can be very big and take a very long time, to the point that a hotel company doesn't even want to build a hotel anymore and they decide to give up on the project. In those circumstances, sometimes those hotel companies like to keep that construction project separate from the rest of the business in what's called a remote bankruptcy entity, so that if cost overruns get too bad, the additional cost of funding that hotel doesn't affect the credit quality of the rest of the organization. In this case, they create a new corporate entity, and that is where the funding goes. That's where the debt goes in order to build that hotel. Obviously, project finance comes with a higher interest rate because the lenders to a project finance do not get the benefit of the credit coverage of the rest of the organization. So we come back once again to this concept of risk return and how to think about it. Oftentimes, the lenders in project finance will ask the parent company, the hotel company in this case, to fund a bunch of equity into the other entity to make sure that they have skin in the game and care about the project surviving as well. Two other forms on this page to round it out. Convertible debt. This is debt that can convert into equity under certain circumstances. You often see convertible debt in tech, especially in growth and venture companies, where people are lending the company money, but want to be able to participate in some of the upside if the company does well. In this case, the contract of the debt has a feature in it which says we can convert our debt to equity at some certain price, usually a higher price than where the stock trades today. And if the stock goes up, we get to appreciate and play in some of that upside through that. So convertible is kind of a combination of debt and equity in one. And then the final one we have on this page, but by no means the final type of debt, is bridge debt, which is debt that kind of gets you through a company through a short period of time. Let's say they have a big customer win coming, or they're completing some new activity which will unleash a whole bunch of revenue. If they need debt or financing to get them from now to that point, a bridge loan is a short-term loan, which once again tends to have a higher interest rate, but which gets paid back relatively quickly if things go well. So now I'm going to hand it over for questions. Irene?
Yeah, thank you, Justin. Hi, I'm Irene. I'm Overlap's Director of Content and Comms. And I was just curious, with all of these different kinds of corporate debt, how does, a company's management find the right mix of debt and equity that works for them? How do you compare all the different capital structures? Is there, I don't know, a formula, or how does this happen?
That is an excellent question, Irene. I would say that this is an art and a science to figuring out what capitalization is correct for a company. The CFO is typically the person at a company who is closest to this, but obviously a lot of CFOs come from corporate operational backgrounds and don't necessarily have the knowledge base associated with Wall Street and financial engineering to do this correctly. We always feel that companies should make sure that they have the right guidance and counsel and advice when structuring the capital structure correctly, because if you do things incorrectly, you can really wind up in a place where you limit your flexibility and your cash flow and your upside, which is not a good thing. Obviously, Overlap is viewed as a trusted provider of such advice and services to companies within the frontier tech ecosystem, and are happy to provide that service for those that are considering getting scaling debt, as part of their operations. In addition, lawyers, financing attorneys tend to be very good at this. There's a few firms that we know well and trust and can recommend to people if they're looking for that. And there's also investment banks who can help companies do that, although they tend to want a nice fee for that experience as well.
Got it. Thank you.
All right. Well, thank you very much, everybody, for your time. We hope you found this informative. We ask you to check out the Overlap website and our LinkedIn page for more resources and information. Have a great day.